Meantime, U.S. Treasury yields extended the retreat today. The 10-year rate falling to its lowest level since May. The chartmaster says there's even more room to run to the downside. Carter Worth of Worth Charting joins us now. Carter, what are you looking at?
Sure. I mean, we're in that nice spot where lower yields are giving a lift to equities. And yet, as we go lower, and I think we go lower, it's going to not be the elixir that it has been. Let's look at a few charts. So looking at, of course, price first. This is the TLT, the iShares 20-plus year Treasury bond ETF, and it has all the elements of a reversal formation. It doesn't matter whether you call it a head and shoulders, but the sequencing is changing. And so if we were to say, where might this be headed, the second chart attempts that. There's a downtrend line, it's well-defined, and I think we're going to head up to around 123 on TLT, which closed out at 118, 119 this week. So what does that imply for the 10-year yield? Well, let's look. Two charts. The first is, of course, this is 10-year yields, U.S. 10-year Treasury yields, and it is the inverse. We know that rates actually peaked at 3.5 over a month ago, the 16th of June, and this reversal formation is fairly well defined as well. So where might we be headed if and as TLT is headed to that downtrend line? Well, the 150-day moving average comes into play at around 2.5%. And my hunch is we probably are headed a bit lower than that.
A bit lower than that. Carter, thanks. I'll see you in a few minutes on OA. All right, so here is the question, and we sort of touched on this, Julie. If we know that rates are going down, let's assume Carter's right, and rates are headed lower. They are headed lower from here. Do stocks find a floor because of that? Or is the reason why the rates are going lower, will that eventually pull stocks down?
Yeah, I think at the end of the day, the fundamentals are going to matter. I know they haven't for a long time, but I really do believe eventually they start to matter. And rates can be as low as you want, but if businesses are really under pressure, that's typically what drives the stock. So I would say it's much more important to have an understanding of the drivers of the business, and if those are changing, if they're getting harder, what is the stability to margins? We have a lot of cost pressure. It's great if we've peaked on inflation, but if it stays persistently high, that's not really that great, right? It's just a math thing to be on a peak number. But if we're still at 5, 6, 7, 8% inflation, that's still brutally high. So I think the fundamentals are what really matters in terms of driving the stocks. And if we see weakened demand, it's going to be a problem.
Yeah. How do you invest, Grasso, in a sub 2.5% world, seeing that the last 2.5% world we saw maybe 2 times ago was like a very different world?
So I have been Mr. Recession. I've been Mr. R.
Yes.
But the problem is, I do think that you could thread the needle with a rally going into a lighter CPI number next month.
Okay.
Then I think the market, just to be a little too cute on the market, I think the market sells off on margins, on compression, on everything that we already know about. Then I think we rally after the midterm elections. So I do think that we actually have a rally come November into December. But when you're investing in this, I think you have to go. People have equated large cap tech with safety. So I think you stay to a large extent with your core in names that are value tech, and then you go outside of that and you go into the value complex. But if you believe in a recession and it's coming, then you have to go safety, and you want to invest in utilities and things that can provide you with some sort of a safety floor. But don't kid yourself, everything gets hit.
Okay, so there is a difference between a world in which we are heading to sub 2.5% and the world in which we've hit sub 2.5% going forward, Tim. I mean, is that marker, right? That bottom sort of, is that the signal to be, you know what, I'm in on stocks again?
No, I don't think so. I mean, look, I would just go back to where we are in markets relative to the all-time high, where we are in terms of the duration of what has been a bear market, and vis-a-vis where I think we still have to root out inflation and not even close. We also have to forget, and I think we all want this deep down, even though we don't, the Fed put is gone. So while the long end may be, getting ahead of the Fed and implying that you have some maybe deflationary trends, you certainly have some control over inflation, I don't think it ultimately tells you where we are going here. So I don't feel as if we've had a chance to really price in. I don't think the cycle of this market move also, I've mentioned this a couple of times, when you've had inflation-inspired recessions in our history, one would be 2000, but you really have to go back because we didn't have a whole lot then, but it's really more 70s and then early 80s and mid 80s. Those are much longer cycles and market pullbacks. Not pulling for this. And arguably with how efficient markets have become, proliferation of information and overly transparent Fed, you might have some of these moves more truncated, but we just haven't seen it. We haven't heard from any of big cap tech talking about enterprise pullback. I kind of want to hear that, and I think we have to hear it.